Every 2 weeks, money appears in your bank account. You check the number, you move on. You don't think about where it came from. You don't think about where it goes. You don't think about the fact that for 99% of human history, that transaction, labor exchanged for currency, was the only wealth-building tool available to you. Not the best tool, the only tool. The idea that you could make your money work while you slept, that it could compound quietly in the background until it was worth more than you could earn in a lifetime, that was not a concept available to ordinary people. For most of human history, wealth didn't grow. It just sat there. Gold buried in a field was worth exactly as much in 50 years as it was worth on the day that you buried it. Land passed down through generations didn't multiply in value. It was just land. The machine that actually built wealth, the one that can turn $10,000 into $750,000 over 40 years without you touching it, has only been accessible to ordinary people for a couple decades. So how did it get built? And why does the feeling that it wasn't built for you turn out to be so true? The answer changes everything we think we know about money, markets, and who gets to participate in either of them. It all started with a ship. Yup, a ship is the reason any of this financial market stuff exists at all. In the early 1600s, trading voyages to Asia were the most lucrative and most dangerous investments in the world. A single successful voyage could return 400% on investment. A single failed one, a storm, a mutiny, a rival fleet, could wipe out everything. The risk was so enormous that no single merchant could absorb it alone. So in 1602, the Dutch East India Company, the VOC, did something that had never been done. They didn't just pool money from wealthy merchants. They went to the public. Craftsmen, shopkeepers, anyone with capital. They issued shares. Not loans, not bonds. Actual stakes of ownership in the company itself. And here's what nobody tells you about the reality of that moment. A share of the VOC was the most abstract thing a person had ever owned. It was just a piece of paper. It said you held partial ownership of ships you'd never seen, crewed by sailors you'd never meet, sailing to ports most people couldn't locate on a map, to return in 3 years. If they returned at all, you couldn't eat it, you couldn't wear it, you couldn't trade it for grain at the market. This is not an exaggeration. Holding a share certificate felt roughly like being handed a promissory note from the future. The value was entirely theoretical until the ships came home. Yet somehow, many people bought the dream. Within weeks, the VOC had raised the equivalent of billions in today's money. Within 2 years, people were trading those certificates the way they traded any other commodity. The Amsterdam Stock Exchange, the world's first, had been born. But here's what happened next. For the next 300 years, this system was not for you. Not middle class, not working class. Wealthy, the kind where you owned property, employed servants, and were addressed by title. In 18th century London, exchange membership required sponsorship from existing members. In early America, securities trading happened between wealthy men in coffee houses. The entry costs were prohibitive by design. The market existed. It was growing. And if you were an ordinary person, you had no access to it. Think about what that actually meant. In 1880, the railroads were printing money, transforming the entire American economy, connecting cities, moving goods, making fortunes. The workers laying that track could see the wealth being generated around them every single day. They couldn't touch it. The average railroad worker couldn't buy a share of the company he worked for. He could only sell his time, and when the selling was done, the wealth went entirely to the people who already had enough to invest. That asymmetry between people who own things and people who only sell their labor was not an accident of nature. It was a design feature, one that took over a century, a catastrophic crash, and several acts of Congress to begin dismantling. The dismantling started with a collapse. In 1929, the stock market didn't just fall. It revealed what it had always been. The crash exposed something ugly hiding in plain sight. The entire market had been built on leverage, manipulation, and deliberate opacity. Companies didn't have to disclose their finances. Brokers recommended stocks they were secretly selling. Insiders traded on information the public never had. The game was rigged, and for the first time, everyone could see it. Congress responded with the Securities Acts of 1933 and 1934. Public companies had to tell the truth. The SEC was created to enforce it. This was not a small thing. Mandatory financial disclosure is the reason you can look up any public company's revenue, profit margin, and total debt tonight, for free, from your phone, in seconds. It's the single reform that made the modern market remotely trustworthy. But it still didn't open the doors. The market was now honest. It was still a club. That changed on May 1st, 1975, called May Day on Wall Street, and the name was not accidental. Before that date, brokerage commissions were fixed by the NYSE. No competition, no negotiating. High by design, because high commissions kept the market a club for people with enough capital to absorb them. After May Day, commissions collapsed. Discount brokers entered. Technology followed. The race toward zero ended in 2019 when Schwab eliminated trading commissions entirely. But here's what almost nobody noticed. Even at zero commissions, the market had one more wall built into its architecture. One, the democratization narrative completely skipped over. Stock was sold in whole shares. A zero commission trade on a $400,000 share of Berkshire Hathaway cost you $0 in fees and $400,000 in cash. For generations of ordinary investors, the price of a single share in the best companies was still an impenetrable ceiling. Historians wrote about expanded access. Journalists covered May Day as the turning point. Economists cited falling commissions as the great equalizer, and the whole time, the minimum buy-in at the best addresses on the market was more than most people earned in a year. Fractional shares changed that. They only became widely available in the last decade. For the first time in 400 years of market history, you can own $5 worth of any company on Earth. The wall didn't come down in 1975. It came down around 2015, and barely anyone marked the moment. Now here's the part that should make you uneasy. The market opened up, technically, but not equally. The wealthiest 10% of Americans own approximately 93% of all stocks. The bottom 50% own about 1%. This isn't a market failure, it's math, and it compounds. If you had $10,000 invested in 1980, the S&P 500 would have turned it into roughly $750,000 today. If you had $1 million invested in 1980, that same return rate would produce a $75 million return. Same percentage. Radically different life. Every decade without access, because commissions were too high, because the habit wasn't inherited, because no one in your family had ever owned a share of anything, was a decade of compounding that didn't happen. That's not recoverable with better stock picks. Time is the only input that produces compounding, and time, once spent, is gone. So here's what all of this adds up to. If you feel like the stock market wasn't built for you, you're not wrong. For most of its existence, it literally wasn't. The feeling of being a late arrival, the sense that everyone else figured this out before you, is not a personal failure. It's an accurate read of 400 years of structural exclusion followed by barely a decade of genuine access that nobody announced clearly enough. What if the anxiety you feel looking at a brokerage account isn't financial illiteracy? What if it's your family's unbroken chain of exclusion, the railroad worker, the sharecropper, the shopkeeper who couldn't afford the commissions reaching forward through time? You didn't miss the boat. For most of human history, there was no boat. The market is a machine for converting time into wealth. Not skill, not intelligence, not secret knowledge. Time. A dollar invested at 25 is worth approximately 16 times more at retirement than a dollar invested at 45. Not 16% more, 16 times more. The 400 years of restriction that preceded this moment were a theft of compounding time. From the railroad worker who could only sell his labor, from generations who watched wealth accumulate in other people's accounts while they waited for doors that were never going to open. Every 2 weeks, money appears in your bank account. You check the number. You move on. What you're actually looking at is the downstream output of 400 years of invention, collapse, legislation, and finally, recently, imperfectly, access. The railroad worker in 1880 couldn't do what you can do tonight. The craftsman in Amsterdam in 1602 couldn't do it either, even though he watched the whole thing begin. For most of human history, the wealth-building machine existed. It ran continuously. It compounded relentlessly. But the door was locked, and now you have the key. Don't just leave it in your pocket. Get up and open the door.